7 years from now, the car you buy today may be scratched, outdated, worth less than half its original price, and sitting in a repair shop. But there is a growing chance you will still be making payments on it. That is the reality of the modern American car market. The vehicle is sold as freedom, but the loan can follow you for 84 months. And the trap usually begins with one harmless question at the dealership. What monthly payment are you comfortable with? Notice what is missing. The salesperson did not ask what price you can afford. They asked what payment you can tolerate. A $45,000 vehicle sounds expensive, but $750 a month sounds possible. Stretch the loan from 5 years to 7, and a more expensive car suddenly feels affordable. The price did not shrink. It was divided into smaller pieces and pushed into your future. In the first quarter of 2026, the average payment on a new vehicle reached about $770 a month. The average buyer financed almost $44,000, and the typical loan lasted close to 70 months. Used cars looked cheaper, but buyers faced average interest rates above 11%. The finance industry did not solve expensive cars by making them cheaper. It solved the problem by making the debt longer. Imagine someone enters a dealership planning to spend $35,000. The salesperson shows them a larger SUV. The buyer says it is outside the budget. Then the loan is extended, and the upgrade becomes only another $90 a month. The buyer stops comparing prices and starts comparing payments. Then come the extras: an extended warranty, paint protection, tire coverage, gap insurance, service plans, and dealership fees can all be added to the loan. Each item sounds small when spread over 84 months, but the buyer is now paying interest on products that may be overpriced or forgotten before the loan ends. The real danger appears after the car leaves the dealership. Cars lose value. Loans do not lose value nearly as quickly. During the first years of a long loan, the vehicle may depreciate faster than the balance falls. That creates negative equity, meaning the owner owes more than the car is worth. In early 2026, more than 3 out of every 10 vehicles traded toward a new car purchase carried negative equity. The average underwater buyer owed more than $7,000 beyond the vehicle's value. Imagine owing $27,000 on a car worth only $20,000. You want to trade it because it needs repairs, or your family needs more space. The missing $7,000 does not disappear. The dealership can roll it into the next loan. You drive away in a new car, but part of every payment is still paying for the old one. This is where a car loan becomes a cycle instead of a purchase. The new balance includes the new vehicle, taxes, fees, and debt from a car you no longer own. To make that balance manageable, the loan is stretched again. Among buyers rolling negative equity into a new vehicle in early 2026, the average payment reached more than $930 a month. Even without trading early, an 84-month loan creates another risk. The payment can survive longer than the excitement, the warranty, and sometimes the vehicle's most reliable years. By year 6, the owner may be paying for the loan while also paying for insurance, maintenance, and repairs. The monthly payment is only the number used to sell the car. It is not the true cost of owning it. A $770 payment becomes more than $9,000 a year. Add insurance, fuel, registration, maintenance, and repairs, and one vehicle can consume well over $1,000 every month. That money cannot build an emergency fund, pay off credit cards, become a home deposit, or grow inside a retirement account. The car may look like wealth in the driveway while quietly preventing wealth from being built. Why does the system keep moving toward longer loans? Because almost everyone benefits when the buyer focuses on the payment. Automakers sell more expensive vehicles, dealers close larger deals, lenders collect interest for longer. The buyer gets the car today without confronting its full cost. But most of the long-term risk stays with the buyer. If income falls, insurance rises, or an emergency appears, the loan does not adjust. Missed payments can damage credit and lead to repossession. Losing the car can also mean losing the ability to reach work. Financing a car is not always a mistake. Millions of people need reliable transportation, and paying cash is not realistic for everyone. The mistake is allowing the monthly payment to make the decision. Start with the total price. Compare financing before entering the dealership. Look at the interest rate, amount financed, loan term, and total amount you will repay. Be careful when every budget problem is solved by adding another year to the loan. Never treat the maximum payment a lender approves as the amount you can truly afford. A smaller car paid off in 5 years can create more freedom than a luxury car financed for 7. Keeping a reliable vehicle after the final payment may not look impressive, but those payment-free years can build real financial security. The question is not whether you can make the payment next month. The question is what this car will cost your future. Because when a dealership turns a $45,000 price into a comfortable monthly number, it is not making the car cheaper. It is selling you time, 7 years of income, 7 years of limited choices, and 7 years in which the car grows older while the debt remains alive. If this video changed the way you look at car payments, subscribe to the channel. We break down the debt traps, hidden costs, and financial systems shaping your money before most people notice them.